Hello, students and classmates. I am Iko Milyonga, and I'm going to assist you in your financial accounting problems. Today, we are going to look at recording financial transactions, and we are going to look into the problem posed by one of our mates, one of our classmates. And this problem comes from the financial accounting course book, Financial Accounting for OHADA member states, written by Dr. Michael Foze. Hope all of you have this. Now, this problem or this exercise is on page 173 of the text. So if you go to page 173, you will see the problem there on illustration 7.1. I will be very short and precise in this video. I wanted to do a live video, but due to the fact that most of you students may have difficulties in having speedy internet, I decided to do a recording instead, and I will upload it in the WhatsApp group for you to follow up. I will be waiting for your questions, and any critics will be accepted. Now, I will move straight forward into recording these transactions into the various books of prime entry. Like I said, I will not go into definition of accounting, books of prime entry, and all that. What we are going to look into today is recording financial transactions into books of prime entry and ledger accounts, balancing them off and posting them into the trial balance. And without much to say, I will go directly into the transactions. Illustration 7.1. KAKA set up a business, and in the first 9 days of trading, the following transactions occurred. Now, I will do the illustrations using my Excel spreadsheet, but you, in your exams, you will be required to do this on paper. And as accountants, you are required to do clean work. Your work needs to be tidy and nice for the examiner to be able to read on your entries. I will take you now to my spreadsheet. Okay, good. I'll take you now to my this is my spreadsheet. It's an Excel spreadsheet. On it, I will show you how to enter transactions. I will show you how to enter transactions into the various ledger accounts and books of prime entry. Excuse me. I'll take you first of all to the cash book. Our first transaction there, we are going to make use of the cash book. I want you to note here that the cash book is the same as the cash account. The cash book with the bank column is the same with the bank account. So it is either you do a cash book and you take the balances to your trial balance, or you do a ledger account of cash and bank. But preferably, you use a double column cash book with a cash and bank column. Now, before I go into the details of this entry, I would like first of all to note certain aspects of double entry accounting. You have to bear in mind and bear on your fingertips this. Assets increase on the debit side and reduces on the credit side. Expenses increase on the debit side and reduces on the credit side. Liabilities increases on the credit side and reduces on the debit side. Capital, which is a liability because it is the amount of money that the business owes the owner, increase on the credit side and reduces on the debit side. This goes with other forms of revenue, sales, increase on the credit side and reduces on the debit side. That you have to know on your fingertips. Equally, you have to know that accounting is made up of principles which are divided into concepts and conventions which have to be respected. When you respect these concepts and conventions, you'll be able to do an accounting properly. Okay, now I will take you to the first book of prime entry here, which is a cash book. And we have here on the 1st of January, KAKA introduces 10 million francs CFA capital by check. KAKA introduces 10 million francs CFA capital by check. We see two accounts will be affected there. Whenever you hear of check, you should know that a bank account is involved. If it's the cash, then you know that it will affect the cash account. So the capital account will be affected and the bank account will be affected. If you introduce capital into your business, you are in fact giving money to your business and you are waiting for the business to pay you back plus interest. So the capital will increase, so we debit capital, and the money you put in your bank account will increase the bank balance, so we debit your bank since it's an asset. So we will do the following entries. Now you follow it. I'll go into my cash book on that date. I will enter the 1st of January 2019. The reference here could be any sequential number. It's not very important. It is only used for referencing. We'll go into the description. Capital or investments. You can either use the term capital or investments. They are synonyms. Now it will go under the bank column. So we enter 10 million. I will reduce this in thousands because of these brackets you see here. So in effect it is 10 million, not 10,000. Capital goes into the bank, 10 million. And that will open a ledger account for capital. Now, OHADA accounting uses accounting codes. The class 1 accounts are the capital accounts, so you can use your chart of accounts to get code for capital. So either you enter a capital there. For most accounting, you will not enter any code there. However, we can still remove our code or include it to your convenience or to your liking. Now, we have to credit capital because capital is increasing. So we have debited the bank, and the corresponding entry will be a credit entry, plus we debit capital. So on the 1st of January 2019, we say bank, which is of course money that have gone into the bank account, 10 million. That is money that will be used as startup capital. Nice and simple. For every debit entry, there must be a corresponding credit entry of the same amount. So we debit the bank account with 10 million and credit the capital account with 10 million. We are done with the first transaction. We move with to the second transaction. He buys supplies worth 4 million and pays by check. Again, two accounts are involved. So we have to open those two accounts, or we have to do transactions that will affect those two accounts. The purchases account and the bank account. He buys It means he has removed money from his bank account to pay for goods. Thus, the bank account will reduce. The bank account increase, which is an asset increase on the debit side, and reduces on the credit side. So we go to our cash book. Here we have the debits. Let me indicate it here. Debits. And on this other side, we have the credit. So we are going to credit the bank to reduce the amount of money we have in there. So that will be on the 2nd of January 2019. The description goes purchases. So it goes under the bank column, 4 million. And the corresponding entry, we go to the purchases account. We have credited the bank account. The corresponding entry needs to be a credit account. So we go to the purchase account and credit it, and debit it, excuse me. So on the 2nd of January 2019, it's a bank. $4,000 or 4 million, or rather 4 million. That is all with that transaction. We move on to the next transaction. On the 3rd of January, KAKA bought a delivery van for 2 million francs CFA and pays by check. Two accounts again are involved here. Delivery van and the bank. He removed money from his bank account, so the bank will reduce. So we credit bank on the 3rd of January 2019. We say delivery van. $2 million. So we credit the bank account and we debit the asset account. Delivery van is an asset. An asset is defined as a resource controlled by an entity from which economic benefit will flow into the business as a result of the use of that asset or as a result of past events and which can be measured reliably. We now debit the asset account. We have credited the bank and we bought a delivery van. So we open a ledger account of delivery van. This is the ledger account of delivery van. This line, this three accounts should span your A4 sheet of paper, giving enough room for the date, the description and amount for on the right hand side, as well as the date, description, amount on the left hand side. It should be broad, and that will cause your work to be tidy. So we debit the delivery van, which is an asset. So that transaction took place on the 3rd of January. So let's say 3rd of January 2019. Delivery van, or we say bank, because the money left the bank account to buy a delivery van. 2 million. So we have completed the double entry for that transaction. Excuse me. The fourth transaction, and on the 4th day, KAKA buys 1 million CFA of purchases on credit. Of purchases on credit. On credit means He is a debtor. And the person who sold to him on credit is a creditor.